Yes, I know big English is not a word, but should that be even where your focus is? So guys, focus. Now, every field has its own unique terminologies. In law, they have terms like ad damnum, ad litem, informa pauperis, deposition, and jurisprudence. There's also a very interesting term that we call lose for when you lose a case.
In Forex, there are some terminologies you need to understand so you can trade with confidence. First, it's market participants. These are different types of people that trade in Forex markets. There are the retail market participants, people like you and I, who are trying to make honest investments and grow our money. There are central banks of the world from America to Wakanda and Zumanda that are trying to buy foreign currencies for their countries. There are the arbitrators who take advantage of the price difference in the different markets to make a profit. There are the speculators who take big risk, hoping to make big rewards, and the hedgers who are trying to avoid risk altogether. Then there are the Forex dealers, and these are usually the banks who are looking for the foreign currencies to meet their customers' needs.
The second terminology to understand is currency pair. A currency pair is the quotation of two different currencies. When you open your Octa FX app to trade, you will see something like GBP/USD. What that means is that the value of the British pound is quoted against the US dollar. The first listed currency of a currency pair is called the base currency, and the second currency is called the quote currency. What this means is that when you place an order on a currency pair, the base currency, in this case, the British pound, is bought, while the second listed currency or quote currency is sold. When trading currencies, you're selling one currency to buy another, and this is based on their bid price, which is the price a broker will buy what you're selling, and the ask price, which is the price the broker will sell to you what you want to buy.
Now, remember, if you want to trade a currency pair containing the British pound and the US dollar, the bid price is the price that the Forex broker will buy the British pound from you in exchange for the US dollar that you want. Let's take a short recess, shall we? It's time for the hourly push-ups.
So where were we? Yes, bull and bear markets. Simply put, a bull market is where prices are going up and a bear market is where prices are going down. Believe it or not, I know this because bulls attack going up while bears attack by bringing something down.
Up next, we have a long and short. And no, I'm not referring to physical height. Long and short refers to how you buy. If you buy long, what you are saying is that you expect the currency you are buying to rise. If you're buying short, you're expecting the currency you buy to fall.
Let's say you want to make a trade on the currency pair of the US dollar and the Japanese yen. Our base pair is the USD and the yen is our quote currency. Because every currency trade involves a pair, you will always simultaneously go long on one currency and short on the other when making a trade. When you're long a currency, it means you are betting the base currency or the US dollar will be equal to or more than the yen in the future.
The next term you should know are called leverage and margin. To put it plainly, leverage is the ability to borrow money or capital to be able to make bigger trades and set yourself up for the bigger profits. The truth is about money is that it costs money to make money, and you need more money to make more money. And that's what leverage does for you. The margin, on the other hand, is the amount of money you need to have to qualify you to get leverage, and it is usually a percentage of the leverage you need.
Because there is no reward without risk, leverage can make your losses a lot worse, and that may lead to what is known as a margin call. What is a margin call? A margin call is what happens when you borrow money and things get out of hand and the broker decides they no longer want any of the smoke. But if you manage your risks the right way, you should avoid margin calls. Lucky for you, we will cover risk management in another episode.
The next term is correlation. Forex correlation is the connection between two currency pairs. There is a positive correlation when two pairs move in the same direction, a negative correlation when they move in the opposite direction, and no correlation if the pairs move randomly with no detectable relationship. A negative correlation can also be called an inverse correlation.
The last terminology you need to know before you get started is hedging. Hedging is one way you can manage your risk. It is opening trades in a way that allows potential profits from one trade to make up for losses from another.
One method involves opening positions or trades on 3 currency pairs. Remember, every trade means that you are going long on the base currency and short on the quote currency. For example, a trader can open a long British pound or USD or Japanese yen, and short British pound, Japanese yen positions. Since a trader has one buy and one sell position for each currency, it is called a direct or perfect hedging strategy.
Another hedging strategy requires the use of highly positively or negatively correlated currency pairs. An example of this would be the opening of long Euro USD and short Euro Japanese yen positions simultaneously. Since these two pairs are highly correlated, the loss in one case can be the offset by the gains made from the second trade. And that's that.